We're going to be taking a look at the various ways most Americans purchase their vehicles and then how that compares against utilizing the infinite banking concept. And all we're really going to do is change a couple of the things you're already doing. Number one, how you think and behave with your money. We're going to show you how to treat your money like a bank, and then we're going to change where we save our money. And those two things are going to have a drastic difference in the end game doing the same thing we're already doing. So let's take a look at possibly the most common way that people purchase vehicles, which is to save up money in their checking account and then go get a bank loan for a vehicle. So we're going to look at a 50-year time period, and we're going to be saving up $10,000 a year into this savings account. Now, we know these savings accounts at most major commercial banks don't pay anything, which is one of the reasons why the banks don't leave their savings there. They leave it with life insurance companies. And so if we put in $10,000 a year for 50 years, that's $500,000. And we're going to go out and borrow money from a commercial bank and pay the bank back with some interest. So in this case, we're going to buy $30,000 vehicles, and we're going to purchase the first one in year 4. And we are going to purchase 9 vehicles over this 50-year time period. We're going to pay these back to the bank over a 5-year time period at a 6% interest rate. And so what you can see here is that we borrowed $30,000 9 times for 9 vehicles, $270,000. But with principal and interest, we paid back $320,485. So if we take 500,000 minus 320,485, then we get the number 179,515. And this is why you'll hear a lot of people move to the cash position, because they don't want to pay anyone interest payments. We don't like seeing that, call it $50,000 of interest flowing out of our hands and into the hands of the banks. And so we pay cash. So let's look at that scenario now. Let's assume we're going to change this to minus 100, and we're going to select the account cash. And so now what this is showing is we're using our checking account, and we're just going to take the money right out of the checking account instead of borrowing it from a bank. So if we take 500,000 minus 270, we're going to get $230,000. So clearly, right off the bat, we notice there's a significant difference between paying cash and borrowing someone else's money and paying them with interest. And this is why most people tend to lean towards the cash option. Now, this was me prior to understanding how the banks work and where they keep their savings. And so now that I understand infinite banking, that mindset has shifted. So let's start to go down that path. So what we're going to do now is just change our behavior with money. So if we are willing to pay a bank 6% interest, what if we treated our checking account like a bank and we borrowed from that account and paid that account back with some interest? So let's change this back to 6%. And now what this is showing is if we used our checking account as the banker, we borrowed $30,000 and we paid back 6% interest to our checking account. That means extra money is coming back to our checking account instead of going to a commercial bank. We end up now with $550,000. 485 instead of the original 500,000. So we're going to take 550, 485 minus the 320, 485, which is the principal and interest. And look at that. $230,000. We're at the exact same place the person that was paying cash was. Now, let's take it a step further. If we know we're going to be financing vehicles or buying vehicles every 5 years, let's assume now we're going to stick that money inside a CD if we know this is something we're going to do on a regular basis. So we might as well change the savings environment and earn a little bit higher rate of return. So let's assume we put this into a CD that's earning 2% now. And so just by changing your savings environment, look at the difference this has on your account down here at the bottom right. Now we're up to $919,000 just by changing where your savings is residing. Now, anytime that you have an account like that, an investment or a CD, something that's interest bearing, typically you have to take on the government as your partner in the form of taxes now. So we have to factor in taxes. We're going to assume a 30% tax bracket. And so over that 50-year time period, total, you pay almost $100,000 in tax. So our true net is actually $782,579. Now we're going to subtract the $320,485 for the vehicles. Now we're at $462,094. So that is the best option so far. We've changed how we view our money, and we're paying our themselves back with some interest in this case, and we changed the savings environment to get a higher rate of return on that savings. So those two things made quite a big impact. Now let's look at taking it one step further, because as good as that scenario was with a CD, we need to understand and just do what the banks are doing, not necessarily what they tell you to do. So with all that money that they make, they choose to keep their savings with life insurance companies for a number of reasons. Now, one of those reasons is they get a much higher rate of return than any CD or checking account is going to pay. And so right off the bat, that increases your savings rate drastically. The other really big piece to this is you also get to eliminate the taxes and the government from that situation. And the other unique benefit this policy gives you is the flexible loan provision. So in this case, we're switching this to account loan, which means we're not actually borrowing from ourselves anymore. We're borrowing from the insurance company against our cash value, which allows your savings to earn a higher rate of return completely uninterrupted for your entire life. And so now that takes our ending value up to $1,302,501. And we're going to subtract the $320,485 that we were going to pay anyways for the principal and interest. And so our new net is $982,016. A little over $500,000 difference just by changing your savings environment. You see, and this is why banks love whole life insurance and they keep it as their foundation, because there is no better savings account in the world other than whole life insurance. It is a very powerful asset that'll give you some unique advantages in the money game. And so when it comes to financing vehicles over a lifetime, you're doing the same thing that everyone else is doing, but your results are drastically different. Now imagine how this could benefit your business, your personal life, your family life, just by knowing this information for something you're going to do anyways.